Good afternoon, all. It's James Gerrish here. We'll get the webinar underway very shortly. I'm joined today by Jules Cooper, who I'm going to introduce in full very shortly. But I think obviously it's the day after or the day of the US election that still hasn't been decided. It's obviously a pretty historical day. We've had some huge market volatility over the last 24 hours or so. So, what we know now is that it's very likely that Biden will take the presidency, but we're likely to have a Republican Senate. So overnight we saw tech stocks, which is obviously pretty topical on today's webinar. The tech stocks rallied pretty strongly on the back of concern being alleviated around the introduction of more heavy regulation. If we had the concept of a blue wave where the Democrats were controlling both houses, then there was the expectation of increased regulation around technology. So that's obviously a positive for the tech stocks. The market today, our market has reacted pretty favourably. We're up on the day, which is obviously a positive outcome. Some of the splits between the sectors are interesting. Similar to what we saw in the US overnight, we've seen obviously tech do well, but healthcare as well. But some of these reflationary trades, so resources and the like, are not going as well today. That's on the back of the likelihood of lower stimulus moving forward. So when it was expected to be a blue wave, there was likely to be a larger stimulus package, infrastructure spending, etc. So the fact that we've got a split houses, or likely to have split houses, then the potential stimulus is slightly lower. So I didn't think I could go without giving a quick introduction around the election, but we'll crack on now, and I'm going to introduce to you Jules Cooper. So Jules is joining us from Melbourne. Can you hear us down there, Jules?
Yeah, I certainly can. James, thanks for having us on.
Thanks, mate. So just for those who are unaware, Jules is our senior analyst here at Shaw and Partners. These webinars are a combination of market matters, and we lean on some of the resources of Shaw and Partners. So we've done a resources one, we've done a retail one, we've done a one focusing on buy now, pay later, etc. So today I'm particularly excited to get Jules's view around, particularly on the software space. So technology is very much front and center, as I've just suggested, and Jules has got some really good insights into the sort of the more the smaller end of the software space, perhaps the stocks that probably haven't garnered as much attention as some of the other technology businesses on the ASX that have done particularly well. So I'm trying to unearth today, along with Jules, some opportunities in the areas that perhaps haven't been as covered by us at Market Matters, and perhaps aren't as well covered across the market. So as I said, Jules is a senior analyst. He's based down in Melbourne. He's got some really insightful views around this area of the market. So I guess the presentation or webinar today is going to be focused on talking specifically about stocks. I'm going to get Jules to set the scene just initially around what's happened in the technology space, the software space over the last couple of years, just to give us a flavour for where we're at in the cycle. And then we're going to drill down specifically into key calls in that space and try to unearth some opportunities for the many attendees that are on the line out there. So if you could just start by setting the scene, Jules, around where we are in terms of the software space. I'm going to get some charts up in the background, so there will be some charts for viewers to be seeing as you're talking. So if you just give us a flavour for where software is as a sector and why we should be thinking about it as a sector.
Sure, thanks, James. All right, well, firstly, I think software. The way I tend to look at software as opposed to the broader technology bucket, we're really looking for areas of the market where enterprises or small business, but organisations spend money with software companies to either improve their efficiency or have a better customer experience or employee sort of experience. So that's the end of the market. It's not advertising. It's not like Facebook or disrupting movie distribution like Netflix. So I look at those businesses as being indicative of a broader theme of technology enabling, transformation. But really, the businesses that I focus on, the software companies listed on the ASX, we're all about understanding the industries that those software companies serve, how they generate value for those customers. And then it's just like any other business. We're thinking about the competitive landscape. We're thinking about the path to profitability, the opportunity for revenue growth, all those, the very, the normal approach with which you'd assess any business. What's a defining feature, though, of software is that for the last 40 years, it's been growing as a percentage of GDP pretty consistently, like 6 percentage points more than GDP. This is just sort of looking at the US where we've got data. So this is not a flash in the pan, theme, if you like. It is a secular growth category that, there's been people smarter than me frame this, but software is eating the world. It is replacing a lot of the menial tasks, and it's changing the way businesses go about the way they conduct business.
Sorry to interrupt there, Jules. So, I mean, a lot of the concern that, potentially the investors may have around this is that they've run really hard. The sector is now, we've missed the boat from a sector point of view, that they've had the big tailwind of falling bond yields. We've had, the big rotation into technology stocks. Technology generally is garnering higher valuations. We've then had the afterburners put on it because of COVID. So, my concern is that we've missed the boat a little bit. Is that a fair call, or is there still plenty of opportunity in the space?
No, I don't think we've missed the boat, but you've certainly, with all those points you just raised, you've got to be mindful of, just how you play the sector. And we've in the stocks that we're covering, and we've recently initiated on 9 of them. I mean, the theme of our initiation was balance. We want exposure to this sector. I think you need to have it in your portfolio. It is a true growth sector, and it's got some really great quality and defensibility characteristics as well. But you don't want to be at the bleeding edge of stocks with valuations. But there are plenty of very good growth stocks on the ASX where the valuations still look reasonably attractive in an absolute sense, and particularly in a relative sense. And then we're looking for just opportunities that have some sort of catalyst that means, over the next 12 months, irrespective of what happens to the broader tech category, we should be able to, see some good outperformance. That's how we're thinking about the sector.
All right. Well, let's dig in and start talking about stocks, because I think that's what everyone is here for. I'm going to spoil the party a little bit and give you the stocks that we're going to cover in terms of today's presentation. So, Fineos, FCL, we're going to talk about that one. Hansen, HSN. We're going to talk about Whispir, WSP. We're going to talk about Class, CL1. We're going to talk about WiseTech, WTC, Altium, Technology One, and Pushpay. There's a couple of topical ones there, and we'll discuss Iris if we've got time as well. There's a couple of topical ones there that have been moving in the last day or so. So Pushpay had an update yesterday. It got clobbered yesterday. Fineos is out with an update this morning. Jules, I'm no doubt you'll touch more on that one. It's down today, so there could be some opportunities in the very short term around some of these stocks. But we'll talk about the ones that you're most optimistic on first up. And the first one was Fineos, which I just discussed there. FCL is the code for that. It's a $1.3 billion market cap company, and I'll let Jules go in and delve you in and give you the background about what they do and why they're a good buy at the moment.
Sure. Okay. Well, for those that don't know, Fineos is a core systems vendor to the life insurance industry globally. So what do I mean by core systems? If you've got making a claim with your life insurance company, you'll call the call center. That call center staff is literally running a workflow that is based on Fineos software. So this is very deep, functionally rich software that runs some of the biggest insurers in North America. The key markets for Fineos are North America, which is the biggest insurance market in the world. About 50% of the global premium is there. And they've also got a very strong position in the Australian market as well. So they've got in North America, 7 of the top 10 carriers use their software, their claims software. In Australia, I think we've got 6 of the top 10 here using their software. So the company's been around, whilst it's only recently listed late last year, the business has been in operations for, quite some, almost 20 years. The founder, Michael Kelly, is based in Dublin, Ireland, with his team over there, and has employees based in all these markets as well, but has been with the company for a very, since inception. And his leadership team, I think collectively there's something like 14 years is the average tenure of the senior management team here, with the head of development with the business for over 20 years. I haven't seen that in any company that I've covered. So that level of experience is something that we think is very important in the insurance space, because you've got very long lead times, around product development, around sales cycles. So it's one of those businesses where if you know where the ball's bouncing and you can look 5 years ahead and position yourself for that, then you're going to be quite successful. And I think that's what we've learned with Fineos, that they seem to be able to do very well. And we expect them to continue to do that.
So this is all about, these sort of stocks are all about growth in top line, and obviously then recycling that or converting that top line growth into earnings over time. What's been the growth in Fineos? What's your expected sort of growth numbers going forward, and what's the big driver of that growth? Yeah,
so the growth for this company comes from signing, new customers to their product suite. Fineos have invested last 5 years in their product suite, so we've got a new suite of products out there for existing customers and new customers to purchase. So really the growth and acceleration in the business that we've seen in the last 12 months has been driven by that. I think last year they signed 9 new deals. That was off the back of just pre-listing. They signed 3 tier 1 carriers in North America. So we're getting really good validation that the insurance carrier market is finally upgrading their technology. Now, this is an enormous market. We know that the industry is slow to upgrade technology. They use very antiquated systems. A lot of their spend is internal. And we just look at Fineos as putting the runs on the board that suggests that they are the market leader, that these big carriers are sort of rallying behind to be their software provider. And we see that as having, a very long runway, call it a decade of growth, probably, at least in excess of 15% a year.
What's it? So that's the longer term picture. And just if you could give viewers a quick rundown of, so an insurance company traditionally would have purchased software, a big upfront payment, and now it's more of a software as a service type model. Can you give us an understanding of what the changes are in the insurance space that's going to drive FCL going forward?
Yeah, for sure. So look, I think what you've got within, if you think of insurers, this is an industry under pressure. So bond yields are low, their investment income's low. You've got regulators asking them to upgrade and invest in their systems. You've got insurtechs being funded to attack these large incumbents. They're trying to get more efficient and they're trying to improve the customer service. To do all of that is really a technology solution or a technology answer. So they've got to get rid of their 30, 40-year-old systems and replace them with new systems. Now, quite often today that is a cloud-based solution as opposed to something you would have on-premise loaded onto your own servers. So we see Fineos as really having a big base of tier one carriers that need to upgrade technology to survive themselves and grow and be sustainable. But we also see there's a whole bunch of new customers that, as they've brought out the new suite, are probably going to be attracted to some of those new products. So there's a multi-pronged growth drivers here for Fineos.
Can you give us, just in the short term, can you give us an update on what happened today? There's obviously news out in the market. It's trading sort of 60 cents lower today.
Yeah, so last night we had their AGM held in Dublin. It was 7 o'clock our time here. And in that update, the company reiterated that they saw 30% growth in subscription software revenue for this year, but did provide some sort of like a little bit of a reality check around some of the services work that they do, just saying, look, you know, in the current budgetary environment, you know, there's some pressures coming into that area of the business, along with some elongated sales cycles. Now, the thing here is this is a business that, you know, insurance is, you know, they're obviously big customers. These are big implementations. So you don't just sell a piece of software and it, you know, you load it in 24 hours and you're up and running. You know, these are projects that extend over years in some cases. They're very big decisions. So when we look at the revenue, it's a function of both that recurring software, the high quality software revenue, together with the implementation fees. So they're just saying a little bit around the edges, the implementation or the professional services work is a bit softer, but the high value software revenue is growing at 30% a year. So the market has today seems to be reacting quite negatively to that. I'm honestly quite surprised. But I think it creates a great opportunity.
What's your rating on it, price target? You've obviously got a buy on it.
Yes, so we've got a buy. Price target's $5.84. I think I last checked, the stock's now trading at $4.14. That is below where it recently raised money from. They did a placement recently, a few months back. It was done at $4.26. It's trading now at 6.5 times revenue. And surprisingly, the stock actually listed at 6.4 times revenue back in August, September last year. So the multiple or the value you're paying for the revenue is unchanged, despite the fact that the business is, the share price is a lot higher. And I do know that there was a director, a board member, industry veteran in the US. He actually put $200,000 of his own money into the business at around $5 only a couple of weeks ago. So fairly dramatic reaction to what I think is just some conservative, you know, thoughtful sort of conservatism around the outlook for the business. Nothing untoward longer term.
All right, we'll jump up to another one being Technology One, TNE, $2.8 billion market cap, again in the software space. Give us the rationale on this one, Jules.
Yeah, so TNE, you know, is a great Australian success story. Adrian DeMarco is the executive chairman, and it's been around for quite some time. Now, it's got a very strong base of local government and higher education customers that buy its enterprise resource planning software. So what's enterprise resource planning? It's ERP. It's kind of the core solution that runs those organizations, covers financials, HR, asset management, the whole box and dice. So again, this tends to be a big implementation. It's a big piece of software. There's a services component. There's a software piece. These guys have over the last 20 years built up a very strong base of existing customers in Australia that they are going through that migration from on-premise software to cloud with those customers. When they do that, they've obviously had to invest a lot of money to enable that product to be rolled out and support their customers. What you get though is the benefit as the software vendor is that you get a step up in your revenue to compensate for all of that cost you put into the business. So we see Tech One as having really gone through that transition for probably the last 3 years. And they're coming to the inflection point now where you start to see the real benefits, the margin expansion, the cash flow. That is all going to come through now, we think, over the next 2 to 3 years. And surprisingly, the stock has underperformed its peers to the tune of 25, 30% since about April. And we just think that creates a really interesting opportunity where, some short-term issues around, higher education, foreign students and their ability to come here, spend money with universities and fund IT projects is just weighing on the company. And I think you're sort of missing the bigger picture, which is really a 5-year picture. We're 3 years into it. We've worn all the pain, and now we're going to get the benefit.
And what's the outlook for growth in terms of top line for T&A?
So this year it's a little bit softer because of the university situation. But as we look forward, I would look at this business as being, growing in that mid to low teens, pretty sustainably. But you're going to get very good margin expansion. So a lot of the cost base is fixed. It's been invested. It's spent. We should see the margin, almost go up 10 percentage points. So we've got 20%, almost going up to 30 over the next 3 or 4 years.
All right, great. So Technology One, what's your rating price target on T&A?
So we've got a buy rating on that. 10.05 is our price target, and that would put the stock on about 44 times adjusted EBITDA or its profit, and it's currently trading around about 38, and has traded as high as 50. Over the last, say 2 or 3 years, there's been a couple of points when it got over 50.
And when they re-rate, so say in March, what's it got down to in March? Obviously 650 on the in terms of price terms, but what multiple does it go on down there?
At that level, that was a pretty crazy couple of weeks, if I remember.
Obviously.
But down there, sort of, that's probably around 25, 26 times.
Okay.
You don't see that too often, though.
Let's keep rolling on. So Hansen, HSN, this is smaller business, $750 million market cap company. Again, the rationale for your positivity on this one, Jules.
So Hansen's a little bit different from the other software, and I'd sort of characterise other software businesses I cover as product companies. They're very focused on their product, selling that to customers and going through the beauty parades and winning the deals. Hansen's a little bit different. It buys businesses that have very sticky customer bases, and it thinks about diversification across its business. So it's more of an aggregator in the software space. So instead of pouring lots and lots of money into R&D, building a new product and hoping that customers will buy it, they approach the software industry as saying, well, let's just buy the business that has the customer and we will continue to support that software and grow with that customer. So it's a different spin on it. For that reason that it doesn't have a clear story, seems to trade quite cheaply. So for example, we talked earlier about Tech One, trading at 39 times its EBITDA number. Hansen, you can buy the same dollar of EBITDA for about 13 times. But when you look in the rear vision mirror at how the business grows, I would say that historically, Hansen's probably delivered 15% top line growth and has delivered very good returns on allocating that capital over, over what is almost a decade of investing offshore. It's probably one of the better records on the ASX of a management team, I would think.
Yep. So yeah, in terms of it's been a real choppy period since listing. it seems to trade within that big range, sort of high twos to it's probably at the top end of its range now. What does it need to, in your view? It's obviously had a good run in the last little while. What's it, before the last week or so? But what's it need to do to sort of get that multiple re-rate and enjoy the same, the same multiples that the sector's on?
I think, what we're hoping to see, and I think we saw the first signs of this at the most recent FY20 result in August, but, is just improve the margin. So for a business that has got relatively low organic growth, you want to just have the confidence that the margin can be sustained or expand. That provides the cash flow then for Hansen to go and redeploy into, nice, attractive assets that they see around the world. So I think that was a big change for the business and something that we're, pretty excited about, that Andrew Hansen, the CEO, has reasserted himself into the company, looking at the cost base, taking costs where he can. And, we know we've got a very defensive, diversified business on our hands here as well.
All right, what's your rating and target and the like?
We've got a buy rating on that one, $4.56 price target. And it's currently trading at $3.71. So, this is a sleep at night software company, is the way I like to think about it.
All right, Whispir, WSP, capped at smaller end of the market. We had these guys in to the office not long ago, $350 million market cap or thereabouts. The rationale around this, what do they do?
Yeah, so Whispir is, if we want to think of that really high growth area of the software world, what Whispir does is provide a cloud communications platform to enterprise customers, largely in Australia, Asia, and a small presence in the US. So what do you mean by cloud communications? I think businesses have basically given up trying to send emails to customers and employees because we don't read them anymore. But they all know if your phone pings, you pick it up straight away. And it's that open rate that means businesses and organizations are thinking, how can we better communicate with our customers and employees, particularly in COVID, where those employees, customers either can't visit you or, spread out all over your city. So what they do is become increasingly relevant, and that is driving the stock. Certainly there's some competitors we look at in the US that sort of signify the growth in this market. And, the likes of a Twilio, Everbridge, PagerDuty, there's a bunch of these companies that are trading on very attractive multiples and delivering growth 20% plus organically. And, I think the penetration of this as a category is very low and will continue to just consume more IT spend.
So when just touching on for Market Matters subscribers out there, so we send SMS alerts when we're doing something in the market. I've looked to use Whispir. We currently use Twilio, have done for the last 5, 6, 7 years as the backbone of our website. We're in the process now of building a new site and looking at all the service providers that we can put into or plug into that site. So when we built the site, I think it was 7 years ago now, it was all about building technology in-house and building things that sat within internally. Now it's about having a platform that you plug all these providers into. You plug all the providers into the platform, and Whispir is something that does that. Twilio has gone spectacularly well. There's other service providers like HubSpot is one that we're using to underpin the back end of the site. There's Stripe in terms of payments. So you get this, the box where you're plugging in all these different software as a service providers, and you're paying as you use them, paying per user, or you're paying as you send messages or texts or whatever the communication that you're sending. So I think it's got a huge future, this sort of plug and play sort of technology.
Yes, couldn't agree more. And one of the things that I think, so if you think about what makes Whispir or their moat, right? We like to think about software companies and what's their moat. Whispir has a very strong relationship with Telstra. And what I'm told by competitors and everyone in the industry is that one of the best things that Whispir did was to get on the good side of Telstra. And they are literally on their website. You can go to their enterprise, solutions. You can see Whispir. It's not white labeled. It's just there, branded on the website. Most of these products get added to your Telstra bill. If you're a big, Qantas, for example, uses Whispir, they are paying for Whispir through their arrangement with Telstra. So it's a very tough thing to break into the market without having that, very good partners alongside you. Whispir in the US now has, in the last 12 months, signed Amazon, Nexmo, and a specialist distributor into the government sector called Carasoft. And we think, there's a real potential for them to take that technology that we know has been proven in Australia, with 500-600 enterprise customers here using that, into the US market, which is enormous. And really that plug and play functionality that you spoke of there is what sort of sets Whispir apart. And we think it, potentially could do very well in the US over the next 2 years.
One of the things that I've noticed over many years is you get a lot of these software companies, smaller businesses coming out there naming these large companies, these brands that they're working with. Obviously gains attention on the stock, is generally pretty positive for the stock price. But when it comes down to actually driving top line and then ultimately earnings, it's pretty light on. As Whispir, is the top line strong? Is it growing? And is it a proper business?
Yeah, sure. It's so I definitely I sympathise with you when you see these announcements. A lot of them tend to be around product, which I think that's nice to know that you're working with an Amazon on product. But when it's a distribution arrangement, that tends to be something quite different. Now, 70% of Whispir's sales come via Telstra or via its channel partners. So if you've got very good quality distributors, that can make or break your business. You then have to invest in the support and the sales capability to close those deals, but that does help. When we look at our forecasts out over the next 3 to 4 years, when we have Whispir growing over 25%, maybe over 20% in the back end of that horizon, but that's the sort of growth we're expecting for this business. And we should see it's not currently profitable, but that sort of execution on the top line will get it there. And then then we'll start to see it'll become a more mature software business with much better scale.
And what's the timeline to profitability?
We see the business breaking even in FY23. So we've got a couple of years still to really just grow that top line to meet the cost base that they've got currently. And when you think about what's going on in this sector and the space, it is a land grab. Time and the idea that I think we've got lots of runway, so that doesn't worry us to have 1 to 2 years of still burning cash when we think we've got probably a 10 to 15 year growth story that we're playing with in terms of that category.
All right, Whispir. So what's your recommendation and price target?
So we've got a buy and a price target of $4.56. So the stock's currently trading at $3.73. And this is one that we'd expect that, it is down the risk end of the riskier end of the spectrum. As they execute, it'll naturally just start to grow its investor base. Market will have greater confidence in the business. And you typically can enjoy that at the smaller end as they mature into, household software company, brands.
So it's capped, as I said before, at 350 million. So plenty of upside potential in that one. Moving on to Class CL1, which is some software that a lot of that subscribers may be familiar with around their superannuation funds, accountancy software, etc. A lot of we feed into Class in terms of our reporting, etc. This is an interesting one to me. Jules, what's your take?
Yeah, so I've covered Class for a long time. I think I was the first analyst to pick it up after it floated, many years ago. So really, it's been a one product company up until now. It's been a fabulous product. They've had great success, cornered 30% of the market from a standing start a decade ago. So it's been a great success story. In the last 18 months, though, it sort of went through a transition where it had run out of probably that opportunity to continue to grow on its core product, and it needed to reinvest into the next leg of its growth, story. So we've invested now quite a sum of money into a product for discretionary trust. So think the super product, the administration engine being applied to discretionary trusts. And also they've made a couple of little acquisitions in the document management space, which is a natural sort of fit to SMSF and discretionary trust administration software. So we're at the point now where that product is launched. So a lot of the development's been done, a lot of the cost has been borne. We now just sit back and we think, well, as the success of that product, and we're selling it into what is a happy customer base with 99% retention. We think that could go quite well, and should be very efficient in terms of generating incremental revenue with minimal cost for Class, which will get the margin back up. And
so is that just on the margin? I was just going to ask that because it seems to me it's now a pretty competitive landscape in this administration area of the market. There's a lot of players out there. Costs are on the decline. From what I see across that area. Is margins an issue?
Well, I think with software, you've got to, particularly, this sort of seat software, the seat-based software, you've got to, there's no incremental cost, really, apart from salespeople and product development. So the way we view Class is they've spent the money, they've built the product. So there's, 70% of your cost done. Now, it's a cross-sell into the existing customer base. So all those customers already have an account manager. They're just selling now a second product. So you've got some really good operating leverage. Depending on the success, if it drives incremental revenue, we just don't see that there's very much incremental cost being applied to that. And you've got to sort of think of software companies that the cost base and the revenue are actually detached, because there really is very low incremental cost, cost of goods, if you like, for these businesses. It's really about, do I have the sales capacity to sell it? And is the product fit for purpose, or do I need to spend developer hours on building it out?
All right, let's. So what's your take on Class in terms of price target and recommendation, Jules?
So we've got a buy on that one and a price target of $2.47. And we see that stock then being valued at about 30 times EBITDA. Currently is trading at 27. And I would point out that if we see that margin improving, if we go back to have a look at some other software vendors in the space, like a MYOB, they had incredible margins, 45% plus, and Class is probably doing 20% today. So, the idea that margins could be a lot higher for Class, I don't think is a massive stretch.
All right, well, let's move on, and we're going to run through the next 4 or 5 pretty succinctly. So the biggest one in your coverage is WiseTech, about $9.5 or so billion market cap. It's been through some interesting times over the last couple of years. What's your take? What's your take here?
Yeah, so look, WiseTech, it's a good business. We like it. It is, you have to pay though for that business in the Australian market. I'd say this is not an undiscovered, software company, and the transparency of the business is not great. So from an analyst perspective, it's we can appreciate they've got great customers, they've got great validation. But as we saw, we came through March, April, there was a pretty substantial downgrade around transaction volumes and delays in products because of COVID. we then look forward and we've had another big upgrade. You can see on the chart there, these big moves. It's just one that it is difficult to get a line of sight on. So the way we tend to view it is we want to buy it when we feel like it just feels cheap, I suppose. So at the moment, we've got this stock on a hold. We've got a price target of $31.18. So it's one that we certainly keep a watch on. We're very interested in, but it's just that lack of probably visibility and conviction.
Global. It's software for logistics, etc. For those not familiar with it, but there's also been a string of short reports out there, and I guess that speaks to the lack of transparency that Jules was just mentioning there around how the business operates and having a really key amount of detail around the financials.
Yeah, I think, and there's not many businesses that have, I think they acquired close to 35 different entities over the space of 2 and a bit years. I mean, that is they were almost, 1 a month there for a while. So that's just that complexity.
Does that make it really hard to split out the numbers around what the organic growth number is versus, and does it make it easier to fudge the figures, if you like?
I don't know if it makes it easy to fudge the figures. I mean, at the end of the day, the cash is the cash, but, allocating that between organic growth and acquired is very difficult. And, remember, these stocks are priced for incremental growth. So it's the subtle changes can drive 3 to 4, multiple points of valuation for this company. Now, you can shift those buckets around pretty quickly, and it would just feel better if we had some cleaner operating history. I think you could get a little bit more comfort in it.
All right, let's move on to Altium. ALU is the code for that, $4.7 billion company, one that we've often written about in the past. Give us your snapshot here, Jules.
So again, Altium, for those that don't know, does PCB design software, so printed circuit boards, those green kind of like biscuit-looking bits with all the solder on them that are in electronic goods. Those products are designed on a software that Altium provide to electronic engineers around the world. So this is a business that it's a niche area. We've got a market leader here in Australia, and they've done a very good job over the last couple of years of lifting their product and increasing their market penetration globally. With that product, though, it's leveraged to the global economy. The purchase of electronic goods or the design of new goods is driven by consumers and businesses. So it's a little bit more cyclical than some of the others. It also has a high degree of upfront revenue that it collects in terms of the business model. So whereas something like a WiseTech or an Iris or a Hansen has a high proportion of recurring revenue, Altium is trying to grow that recurring revenue, but it still has exposed to a lot of upfront license fees. So in that environment, when it's hard to sell, we're just mindful that it can be hard to grow. And we saw in the last half, 3 or 4 revisions to their top line growth. And that dropped straight through to the bottom line, as you'd expect. And when we sort of look forward, we just don't see the economic landscape having cleared enough to get a lot of confidence around that right today.
All right, so you've got a hold on it?
We've got a hold on that one with a $40 and 4 price target. And just sort of feel like that stock's going to be range bound until, the economic landscape looks a bit better.
So current trends to be maintained there. Let's move on to Pushpay. Pushpay Holdings, PPH, is the code for that, a $2 billion business that had some news out yesterday.
Yeah, so yesterday it reported its first half result. So for those that don't know, Pushpay provides digital giving and customer relationship or database software to churches in North America. So this is getting pretty niche. It shows you...
instead of putting your money in the plate that goes round, you do it digitally.
That's right. And certainly with COVID and the social distancing, that meant people cannot attend their church on a Sunday, and it really forced the pastors and the church organisations to embrace digital giving so that they could still collect funds from their members to support the church and the good deeds that those churches do. So Pushpay has been a big beneficiary of that. Its year end runs from March until March. So if you think of when COVID really kicked off, they're really experiencing a full year benefit of that tailwind in this year. And I think there's a little bit of concern with the company about how you back that up in the next year after you've had digital giving probably increase 6 years in 1 year in terms of the rate of penetration. So the result yesterday didn't provide great clarity around how we expect the business to be growing the year after. And certainly the excitement around what's happening, the operating leverage these guys are producing this year has, got people excited. The multiples re-rated close to 30 times EBITDA now, but we'd really expect a business like that on that valuation to be growing at 15% plus, with clear line of sight to that. And we just feel that that's actually quite difficult to see with Pushpay at the moment.
All right. I'm going to, so you got a hold on that stock, Jules?
Yep, 869 price target on that one.
All righty. I'm going to crack on and get stuck into some questions because there's quite a few that's been sent through, and then there's probably a dozen or more that have come through on the as we've been speaking. One of them is your thoughts on IRE is the last stock under your coverage, but IRE, BVS and MP1. I'll let you start with IRE. The others you don't cover, but I'm sure you can speak to, and I'll chime in as well.
Yeah, sure. So Iris is, does financial planning software as well as running trading systems for banks. So it's, core software for the finance sector, essentially. These guys have been focused on acquisitions over the last couple of years. I think they've got a grand plan to combine data and, bring that all together. But it has been a little bit frustrating in that the benefits of the strategy seem to have been just taking a lot longer. Particularly, some of their acquisitions just have not seemed to really deliver the benefits that were promised. So, we're a little bit cautious on that one. We want to see, when that margin can start to improve. So they're starting to get incremental revenue at incrementally less cost. And we just haven't really seen that yet or have the, solid conviction around that's why it's a hold.
All right, IRE is a hold. BVS, this is one we've got in our growth portfolio at Market Matters. It's been a bit of a struggle for us in the last little while after its downgrade or announcement that they were going to do, flat year on year. What's your take here? Yeah,
so in a similar section to Iris, it's certainly big, heavy software. So it's, typically comes with a big project attached to just selling the software. They've got a significant exposure to the UK market. Over there, I think they are feeling it. They've had, Brexit, and they've been clobbered by COVID. And I mean, it's just getting worse and worse. So unfortunately, it's, I think these issues are temporary. But it is putting pressure on their ability to close deals and then generate that revenue to keep the growth, the growth-hungry software investors happy.
All right. And that was Megaport MP1 is obviously not under your coverage, but it's a stock that's pretty much built for this period. We have this in the Market Matters portfolio at the moment. Obviously, it creates it's underpinning the ability to work flexibly around the world. To me, that's a strong growth area. Do you know much about this one, Jules?
Yeah, it's sort of, again, I'd sort of differentiate this from the other software companies, this is more, I think of more of in the data center space,
Yeah.
which tends to be a different ecosystem. But, clearly what they do, connectivity, everything that they do makes logical sense, but it's probably a little bit out of my field of vision.
Yeah, so NextDC is sort of the comp to MP1 listed in Australia. NextDC has probably had the better run of it in the last little while, but we're pretty positive on MP1 from current levels, so we like it. In terms of the other things, live tiles, LVT. So these guys do, there's a question just about this. This is similar, so workplace software, etc.
Yeah, so this is, certainly in our field of vision. So, selling software through to enterprise customers. What they do is, work very closely with Microsoft to provide, the sort of the website technology that organizations would use to run their intranets, things like that. The challenge with, why we don't cover it is that, up until now, it's been a fairly inefficient business. So we're looking for businesses that can increase the annualized revenue that they're adding at what looks to be improving rates. And I know these guys have got to focus on their cost base. They're trying to, improve those efficiency metrics, but we just want to see a little bit more evidence there that, that they can grow their business efficiently as opposed to inefficiently.
Yep. In terms of just a few follow-up questions for those on the line. So is BBS a buy? Jules doesn't cover it. We've got in the portfolio, I think it's a buy down at these levels. It's sort of this deep value play. It's got a few curly things about it, but I think if you looked in the medium term, it looks reasonably cheap at these current levels. There's a lot of questions here just about the buy now, pay later space, which is out of, Jules doesn't cover that area of the market. I'll have a crack at just talking about Zip, because that's one we've got in the portfolio as well. John O'Higgins is our analyst on that. He's got a buy and $10 price target. We've spoken about Zip in the last, we did a buy now, pay later presentation couple of weeks ago, so you can go onto the Market Matters website and you'll be able to find that. But yeah, price target of $10 and a buy. I think it's trading at the bottom of its range. It's underperformed Afterpay in the last little while, just on the back of Westpac selling their stake in Zip. If you look at the run rates that we're seeing out of QuadPay in the US, I think that's pretty exciting. And if you want a little data point that speaks to continuing or acceleration of growth out of QuadPay, you can look at downloads over in the US. They're accelerating, website views, etc. They're accelerating. So to me, we're going into a pretty seasonally strong period for buy now, pay later. I know it's been weak in the last little while, but as I said, it's been digesting that Westpac sell down of that, and also that Afterpay announced to deal with Westpac. So I think there's some digestion over that, but we still rate Zip as our number one in the buy now, pay later space. Another question on Zip, it's obviously a very popular stock. EML payments, there's the other one that we've had. There's 3 questions here on EML payments. Obviously not one in your wheelhouse, Jules, but have you got any comments there?
No, not really. I sort of look at this more as a, payment processing card company, software runs in the background, but it's not really core to the business.
Yep, understand. So in terms of EML guys, I think it's one of the things that I've noticed or observed over the last few years in the payments area specifically is that those companies that have got a really simplified product, a really simplified story to bring to the market have done really well. EML, I think, are a little bit complicated or convoluted in the products that they've got onto the market, and that's sort of speaking, shown through the sort of range-bound nature of the share price. So to me, I think this is in a little bit too hard basket at this point in time. If they provide more clarity around what they are going to do moving forward, I think you'll probably see it break out of the range. But until it does, I don't think there's any reason to be in EML on that one. there's a question here just around the hype around 5G. What ways can we play 5G or the rollout of 5G on the Australian market? There's a little stock that we've listed recently, actually. So there's not a lot of data for it. It's Aussie Broadband, ABB. It's growing the most. It's growing the strongest in the telecommunications space here in Australia. So that's one that would benefit. It's a small company, so obviously is influenced more heavily by stronger growth. Like it's growing off a smaller base as opposed to the Goliath like Telstra or the Vocus, and it's actually stealing market share from Telstra and Vocus. I would say that Vocus is one that we do like. I think that's more of an asset play. So we've got Vocus in the portfolio, having added it recently, but that's more looking at from an asset base and viewing Vocus as undervalued from an asset perspective. I've got another question on Afterpay and Zip. Zip's struggling at the moment. What are the long-term prospects? So I think we're positive on the long-term prospects. As I said, we've got a $10 price target, but I guess the real key is going to be seen this quarter. So the December quarter, the numbers will be out in January. So that's probably the next update that we'll be really focused on in terms of Zip. A question here: should Appen and Altium be part of everyone's portfolio? We provide general advice only, so we won't comment too specifically on that. We covered Altium earlier. Have you got any thoughts on Appen, Jules?
No, again, this is more of a crowdsourced database for the big social media companies.
Yep.
Yeah, that's how it's
relying on artificial intelligence, etc. So more out of the software space. I have had OCL on my watch list for some time and continue to like the company. How is this different to TNE, which I hold, and what do you believe is different about the two?
Yeah, so I think the big difference is that one is better known than the other. So TNE's been in the index. It's like, Objective Corp is, it's not in the index. It's, closely held by the founder. But in terms of the businesses themselves, very similar. They have similar customers. One specializes more down the enterprise content management end of the market. So think of all the, documents and, content that a business has, an organization of that, whereas TNE is more just core financial software. So they work, very well together, quite similar. At the moment, Objective is trading at a premium to TNE on the way we sort of, when we look at those, and, it's enjoyed a very strong re-rate, but I'd see the same, opportunities for TNE. Maybe there's a slight difference where TNE has a little bit more exposure to the university sector, 30% of their business, which maybe that sort of accounts for some of the differential between the two.
All right, thanks, Jules. We're going to wrap it up now. We've answered as many questions as we possibly can. There's a few more there that we haven't got to. Before I go, Jules, what's your number one? If I had to press you here on market prices today, what would you buy today?
Hands down, Fineos. You can buy it today, and in 5 years, you're going to be extremely happy with that purchase.
All right, nice one, Jules. So just to run you through Jules's call. So he's got to buy on Fineos, FCL. He's got to buy on Whispir, WSP. He's got to buy on TNE, Technology One. He's got to buy on Class, CL1. He's got to buy on Hansen, HSN, holding Iris, WiseTech, Altium, and Pushpay at this point in time. We've got a lot of people on the line. Thank you very much for joining today's webinar. We'll continue to roll out these webinars on specific topics, leaning on some of the depth of knowledge that we've got from analysts. So thank you very much for joining us. I hope you've enjoyed it. Jules, thank you for coming online down in Melbourne.
Thanks for having me, James.
All right, see you guys. Bye.